To be with us today. My name is Joe Corio. I'm Senior Vice President here at URL Insurance Group, and we're very happy to have everybody with us today on the call. For those of you who are doing business with URL, we want to thank you for your continued support. We realize that you have a lot of choices of where you can place your business, and we truly appreciate you working with URL Insurance Group. And we promise to do our best to continue to earn your business in the future. For those of you who are new to URL, welcome today. URL is a full-service broker offering a full line of annuities, both fixed and index products. We offer single premium life. We have a traditional life products area. We also do individual and group health products, and we have a senior division. Doing MedSup and MedAdvantage plans. So feel free to check us out. Check out our cutting-edge website, which you see on the screen now. Our address is www.urlinsgroup.com. That's urlinsgroup.com. Okay. Enough with the advertisement. I'm very excited today. We have a great program for you. And as the Senior Vice President here at URL, I also oversee the Annuity and Single Premium Life Division. And very frankly, the fixed annuity business has been booming in the last 2 years. People are finally realizing the benefit of upside potential with no or little downside risk. And the income riders that index annuities have really been fueling the annuity sales over the past couple of years. That being said, the truth is, though, that sometimes what I call sideline money, whether it's savings accounts, CDs, or other funds that people don't need for everyday living, sometimes that money can better be utilized in a life insurance product that provides riders that may benefit your senior clients a little bit better than an annuity, especially as these folks reach their mid to upper 60s and 70s. One such product is the MoneyGuard II product from Lincoln Financial Group. Lincoln has always been an industry leader, and this new revamped MoneyGuard II product is simply awesome. And we're very happy to have with us today Carrie Tenio. She is an internal marketing consultant with Lincoln, and Carrie is an expert on the MoneyGuard II product, and she'll not only share some product information with us today, but also talk about how to present the product and some marketing ideas. But first, before I turn it over to Carrie, I just want to tell you that on your screen you should see an area where you can ask questions by typing them in. Feel free to do that, and at the end of the presentation, we'll answer all the questions. Of course, you can contact us here at URL Insurance Group as well for any information you need. And also at the very end, there'll be a very short one-question survey, and it basically wants to ask you if you want more information on the product or if we don't want more information. And the reason we ask that simple survey is we know that your time is valuable, and we don't want to waste your time. So if you're interested in the product and more information, we'll be glad to help you. And if not, we won't bother you. So it's very simple. So I hope you enjoy the presentation today. Again, type in any questions that you have. We'll answer them at the end. And right now, I'd like to present Carrie Tenio from Lincoln Financial.
Thank you, Joe. As Joe said, my name is Carrie Tenio. I am an internal marketing consultant here at Lincoln for MoneyGuard, and I'm here to talk to you about planning for long-term care expenses and the importance of helping your clients protect themselves from a potential long-term care event. And hopefully I am sharing my screen here with you, and you're seeing the PowerPoint presentation. So if we move forward here on the agenda, we're going to talk about the financial challenge of planning for long-term care, some different options for planning flexibility, and then finally we'll review some prospective clients. So we'll take a look at the financial challenge. Every day, more than 10,000 baby boomers are reaching the age of 65. So that means over the next 18 years, this population is expected to grow to approximately 70 million. So in 3 years, those age 50 and older are going to compose about half of the United States population. So they're going to control about 70% of the disposable income. So this is going to result in a large shift from the client population in the accumulation phase to the distribution phase. So as a result, that's going to drive the need for planning strategies to help protect their portfolio from a long-term care event. So we'll just look at some of the national averages for long-term care. Now these are, again, are national averages. You're looking at about $95,000 per year for a nursing home. That's about $8,000 per month. So if you're looking at the West Coast, New England states, that's going to be well over $100,000 per year. Again, this is just national averages. And we do have a website. It's called myconfidentfuture.com, where you can kind of get a better idea of the cost of care around the nation. And again, that website was myconfidentfuture.com. If we look a little bit further, you're looking at, for home health aides, are going to be about $19.36 per hour, and for a single occupancy suite for a assisted living facility is going to be around $34.25 per month. So now let's look at the perception versus the reality. According to a recent survey published by the Associated Press, Americans age 40 and over, they believe that they can count on their family to take care of them as they age. But the reality is the Americans who are currently receiving long-term care or have in the past are finding out that's not the case. So let's help these clients protect against a long-term care event. And just think the last thing that the client's going to want to have to worry about is making the tough decision of who's going to take care of them, how much is this going to cost, and what assets are they going to sell off first to pay for their care. So your clients should consider, as they age, they're going to need long-term care at some point. So maybe they're going to start in-home, they become ill, maybe they need someone to come in the home, help prepare meals, get their medications together, and then maybe their children are going to be concerned about their safety at home, so they're going to move into an assisted living facility. And then finally, they may require some more intensive care, so then that's where they would end in a nursing home facility. And this could end up being a tremendous financial burden for your client. So another option for planning is, why are not more clients choosing to go with traditional long-term care? Keyword there being traditional. Now, it's a use it or lose it type policy, like your car insurance. You're paying in all the premiums, and you're only ever going to get anything in return if you go on claim. So some don't like that idea of a use it or lose it type policy. Also, premiums can increase substantially over time, and they're also not guaranteed. Long waiting elimination periods, 90, 180-day wait before they can become eligible to receive the long-term care benefits. So they could be paying tens of thousands of dollars out of pocket before the benefits kick in. It's expensive, going back to the possible premium increases. And some clients believe that they can self-insure. They've set some money aside in case there is a long-term care event, but they're taking on the financial risk all on their own. So that's where MoneyGuard comes in. It's a smarter alternative to self-insuring. It's going to provide tax advantage reimbursements for all the clients' qualified long-term care expenses. It's going to offer benefits even if they never go on claim, either through a death benefit or a return of premium option. We also have premiums that are guaranteed never to increase. And there's also no elimination period. So benefits are going to begin as soon as they are eligible. So MoneyGuard, this is where it's going to come in. Again, it's a universal life contract with those long-term care riders that are going to provide benefits even if they never go on claim. And here we have our famous 3-bucket story. And for your first bucket is your long-term care bucket, your income tax-free reimbursements for all your qualified long-term care expenses. You're going to get more for your money, and it's going to be worth much more than your total premium payment. Or you have your income tax-free death benefit for their children or beneficiaries if they don't need care. And then finally, you have your 2 return of premium options. This was a major change to the MoneyGuard II product when we launched it back in February. We now have these 2 return of premium options. The first option, you could choose to maximize their benefits and get more from the policy with an increased death benefit and increased monthly benefits. Or they could choose to maximize that return of premium option and get 100% return available to them beginning in year 5. So let's just look a little bit closer at these two return of premium options. Again, that first option is an 80% return in any year if they choose to surrender. With this option, they're going to see about 10 to 15% higher benefits. So this is the client that's more concerned about the long-term care benefits. Now, if maybe you have a younger client, you never know what can happen later on down the road, and they are a little bit more concerned about the liquidity in the contract, we can go with option 2, which is that vested return of premium option. It's going to go according to this vesting schedule. So in year 1, they can have an 80% return. Year 2, 84. It's going to increase by 4% each year. Then beginning in year 6 is where they can have 100% of their premiums paid back in return to them. So how does a client become qualified to receive the benefits within the policy? They're going to have to be certified as chronically ill by a licensed healthcare practitioner. So that means that they're unable to perform at least 2 of the 6 activities of daily living without substantial assistance from another person for a period of at least 90 days. Now that 90 days doesn't mean it's a 90-day waiting period. That just means it's a condition expected to last longer than 90 days. And again, those activities of daily living are bathing, continence, dressing, eating, toileting, and transferring. And the insured can also be certified chronically ill as a result of a severe cognitive impairment. And they will need to be recertified every 12 months in order to remain eligible for reimbursements. And the benefits will continue as long as they are certified or until the entire long-term care benefit pool is exhausted. And the care is going to be provided under a plan of care prescribed by the doctor, and we will reimburse up to the maximum benefits as specified within the policy. So let's look at a hypothetical client. This is Nancy, 60-year-old female. She's going to qualify for our couples discount. That was also another change from the old product to MoneyGuard II, where with the old product, our underwriting class was either standard non-smoker or a tobacco rating. Now with the new product, we're no longer quoting that smoking status. It's either going to be couples discount, meaning the client is married and both do not need to apply, or standard, not married. So this client, again, she's concerned that an illness can deplete her savings, so she's going to purchase a $100,000 MoneyGuard policy. It's going to give her a 2-year long-term care accelerations of benefits rider. That's our first rider, and a 4-year long-term care extension of benefits rider. So that's going to provide her a total benefit period of 6 years. So let's look at the 2 options here. We're going to reposition a $100,000 lump sum into a MoneyGuard policy. So that's going to give them, I'm sorry, this keeps popping up here. And under option 1, again, that's our basic return of premium, the 80%. You're going to see a higher monthly maximum, $7,200 per month. That's going to be $86,000 per year with a total long-term care pool of $519,921. Or you have your death benefit portion of the contract, $173,307. Again, that return of premium is going to be 80%, so $80,000 of the $100,000 will be returned if they choose to surrender. Now let's look at that option 2, the client that's more concerned about the liquidity option. You'll see slightly lower benefits. With this option, it's going to cost them a little bit more. Monthly benefit, $66.52. Annual is going to be $79,826 with a total long-term care benefit pool of $478,000. Again, slightly lower death benefit with this option, $159,652. And now the return of premium is going to go according to this vesting schedule. So again, year 1, 80%. It'll increase by 4%, so it wouldn't be until year 6 when they can get that 100% back, the $100,000 premium return to them. So let's look at a second option. Maybe you don't have that high net worth client that can reposition a $100,000 lump sum all at one time. So let's look at another scenario. You can do a 10-pay option. You can structure the policy to pay the premiums in anywhere from 1 to 10 years. So maybe this client has an annuity. We could turn on that income stream to fund a MoneyGuard policy. So you're going to see the most leverage with a single premium deposit. So that's why you'll see here our monthly benefits are slightly lower than we saw on the previous slide with the lump sum. But you're going to get a $6,200 monthly benefit, $74,589 per year with a total benefit pool of $447,531. in long-term care reimbursements. Death benefit is $149,000 with that return of premium of 80%, it's $80,000. Again, looking at that vested option, the 100% return of premium, slightly lower monthly benefit, $57.26 per month that we will reimburse up to. Annually, $68,712, and then finally our total long-term care bucket on that vested return of premium is going to be $412,272. So I just want to pull up a actual illustration here for you so you can see what an illustration looks like. So we're going to go to page 3. Again, I just kind of mimicked the hypothetical within the PowerPoint. So same 60-year-old female, couples discount, 6-year benefit duration you'll see there along the top. So we're putting a $100,000 lump sum, monthly benefit $72.21. Now this is a reimbursement policy, so if we're maxing out, if they're utilizing that full monthly benefit of $72.21, it's going to dry up within 6 years. But if they're not utilizing that full monthly maximum benefit, there's potential for this policy to last longer than the 6 years here that is illustrated. So below that, we do have the inflation option. We didn't select an inflation option in this scenario just for educational purposes. Typically at this age we would do a 3% compound, but just to make it a little bit easier to understand, I didn't include inflation on here. Below that we have our deductible period. It is none. There is a 0-day wait with MoneyGuard, so benefits will begin as soon as the client is eligible. Initial specified amount, that's our death benefit portion. So that's $173,307. So once the client turns this policy on and starts receiving reimbursements for their long-term care expenses, they will get deducted dollar for dollar from this initial specified. So when the client passes away, the beneficiary will receive whatever the difference is between the reimbursements and the specified amount. Now, if the client exhausts all of the long-term care portion in the policy, it will still remain in force, and there is this residual death benefit of $86.85 that will get passed on to the beneficiary as well. Return of premium option, this is the 80%, that basic return of premium, so $80,000 would be the return. And then below that, we have our rider charges. This is already built into the contract, so this is nothing additional that the client is going to be billed for. So we'll look at the next page. This is our benefits illustrated over time. Again, we're putting a $100,000 lump sum in. You'll see our surrender value is going to be $80,000 for the life of the contract. Our death benefit amount, it is inflated there in the earlier years. That is to meet the IRS guidelines, that insurance corridor. So it does deflate back down to that initial specified of $173 that we saw on the earlier page. We do have an internal rate of return here listed for the death benefit portion. Now if we jump over to that gray shaded box, this is our long-term care reimbursement benefit limits. So you'll see again that $519 total benefit pool, annual pool $86,654, and then finally our monthly maximum is going to be that $72.21. Again, we have our internal rate of return on the long-term care portion of the policy. So we always like to point out age 80. So if we take a look at age 80, our internal rate of return there is 7.3%. We always use that to kind of fight the argument of self-insuring. If this client wanted to put $100,000 elsewhere, they're going to have to get a 7.3% after-tax return to get a comparable benefits that they're going to see here in a MoneyGuard policy. So if we jump back in the PowerPoint, now we can take a look at some prospective clients. These are some clients that could benefit from a flexible premium strategy, possibly a 10-pay strategy. So first you have your highly compensated professionals. They have sufficient income to make payments over 1 to 10 years. So they're going to gain more asset leverage when they're young and healthy. And we can also include that inflation option as well. Sandwich generation, maybe they're juggling their children's tuition and helping take care of their parents' long-term care expenses. So they're experiencing firsthand a long-term care event. So we could do a flexible premium strategy that fits their budget as well. And we can even do a 10-pay and break those premiums down even further and do a monthly premium as well. Next you have your clients nearing retirement. This kind of goes back to that annuity story. Maybe they've maxed out their retirement contributions. Maybe they have an annuity that we can turn that income stream on to fund a flexible MoneyGuard contract. Next, you have your retirees with tax-qualified assets. Maybe your 70 and older crowd with those require minimum distributions. We can set some money aside to pay out the taxes, and then we could use the balance to fund a flexible premium MoneyGuard as well. So maybe some prospective clients that could benefit from a single premium, a lump sum deposit. You have your executive top earners. They can gain, again, more leverage on their long-term care dollars while they're younger and healthier, and also have tax-advantaged benefits. Single females, they don't want to be a burden on their family, so in one move they can kind of alleviate that concern and also maintain some independence as well. Next, you have your clients in or nearing retirement, a single reallocation that maybe they had set aside for self-insuring. They can kind of protect their cash reserves and reposition into a MoneyGuard contract. And then finally, you have your high net worth clients. They believe they have more than enough money for long-term care expenses, but they're taking on the risk alone, so why not share that risk with Lincoln? So MoneyGuard, we are the leader in the hybrid industry. We've been in the industry for over 25 years. We do have a dedicated internal and external support team, and also you have your folks there at URL, Joe and Maria, as a resource as well. We also have that claim paying excellence. Once we receive the claims in good order, we will pay them out within 5 days or less. We also utilize a streamlined underwriting process. So we're not going to send the client for any type of exam. We're not pulling medical records. What we're going to do is once we submit that application, we're going to do a prescription drug check. That's all done on our end. We're going to look for what we call red drug hits. If everything checks out there, then we're going to have a nurse call your client and do about a 45-minute telephone interview with the client. And they'll go over their health history, prescription history, any other insurance that they may have, and we'll base their decision solely upon what's disclosed in that telephone interview. So it's either approve or decline with MoneyGuard. There's no table ratings, preferred ratings. So all in all, from submission to placing the contract, you're looking at about a 3-week, roughly, underwriting process. So again, you could always reach out to Maria or Joe if you have any clients in mind that you would like to see an illustration for. But I didn't know if anyone had any questions at that time. At this time, for me, I'd be more than happy to answer those for you.
Yeah, Laura, Carrie, we do have a question or two. One is, can they obtain a copy of the PowerPoint presentation?
Yeah, absolutely. I can save this as a PDF, and I'll email it over to you.
Okay, so we'll get that out to Sharon. And then also, are there any special testing or requirements that an agent will need in order to be able to write the MoneyGuard?
Yes, great question. Probably 9 times out of 10 when an application comes in-house not in good order, it's due to a licensing issue, an agent not being properly appointed. Most states require a life and health license in whatever state the client is in. And some states also require an 8-hour long-term care pre-sale course. And then there's also a 4-hour refresher course every 2 years thereafter. So I know Pennsylvania is one of those that requires that 8-hour course and the 4-hour refresher every 2 years. So you'll always want to double check that we have the right licensing and appointment in good order before we take an application.
Okay, and that's a perfect time for me to say, if you do license with Lincoln for the MoneyGuard, we have a voucher that we will extend to you so that you can do your testing at no cost or very little cost. So if you're interested in doing that, let us know. Another question, can this be utilized in conjunction with a traditional long-term care policy?
Yes, you can use it to supplement.
Sure, and that brings up, you know, a lot of people might have purchased long-term care a couple years ago, and they might have the $100 a day benefit, so this will be a great complement to add to it. Or what we're seeing, too, is a lot of people have long-term care plans that the premium just keeps going up and up and up. So what you might consider doing is working with the client to maybe extend the elimination period on that old policy so that their premium comes down a little, and then maybe replace some of that lost benefits with a MoneyGuard II. So there's a lot of ways you can use it in conjunction with the long-term care.
Absolutely. This is a universal life contract, so maybe the client has a permanent life insurance contract where there's no longer a need for a large death benefit. We can 1035 the cash value over into MoneyGuard as well.
Right. Great point. Another question, is the policy a MEC?
It is going to be a MEC. In most situations, it's going to be a MEC, unless we're doing a 1035 or if we're doing a minimum 10 pay. Sometimes it does not turn out to be a MEC.
Okay, so individual consideration on that one. And I guess this is on the 10 pay or multiple pay. Do premiums continue once the disbursement of benefit begins?
If they say we issued out a 10-pay policy and they go on claim in year 5, they are still expected to make those additional premiums, but in that type of event we can do a reduced paid-up policy and recalculate the benefits.
Great. Does the death benefit decrease if long-term benefits are paid out?
Yes. Once they start receiving long-term care reimbursements, it's going to get deducted dollar for dollar from that death benefit.
There's some great questions here. I think that's all I see, though, Carrie. I don't see any other questions. Again, please feel free to contact us at URL Insurance Group, Maria Adams or Joe Corio. It's 800-926-8875. Maria's extension is 102, and my extension is 111. Again, it's 800-926-8875. Got another question here as I was speaking. Benefit decrease. Is the minimum death benefit about 10% of the original amount? I guess you mean the residual death benefit?
The residual death benefit is 5% of the specified, or $10,000, whichever is less.
Okay. Good questions. Okay, I'd like to thank everybody for being on board today. I'd like to definitely thank Carrie for an excellent presentation, and we look forward to doing some MoneyGuard business with you. Again, give us a call if you have any questions, and thank you for your time today.
Thank you.
Everybody have a great day. Bye-bye.